Retirement should be a time to relax, enjoy life, and reap the rewards of decades of hard work. But for many, taxes quietly erode a significant portion of retirement income. 8. Leaving them stressed and scrambling to make ends meet. What if I told you there are opportunities right now, like a 40,000 deduction and Social Security tax cuts, that could save you thousands of dollars every year? These aren't gimmicks or loopholes. They are real provisions designed to help retirees protect their hard-earned money. Today, we're going to break down how these deductions and tax cuts work, the hidden savings most retirees miss, and how strategic planning can help you maximize your income so you can enjoy the retirement you deserve. The 40,000 deduction, how it works and who qualifies. When it comes to retirement, most people focus on income, investments, or Social Security benefits, but few realize the impact that tax deductions can have on their financial security. One of the most powerful tools available to retirees today is the 40,000 deduction. For many, this deduction can dramatically reduce taxable income, protecting thousands of dollars of hard-earned savings. Understanding how it works and who qualifies is critical, because failing to leverage it can mean leaving significant money on the table. First, let's break down the basics. This deduction is designed to lower the amount of income subject to federal taxes. For example, if a retiree qualifies for the full $40,000 deduction, that portion of their income is essentially shielded from taxation. It's not just a small benefit. It can translate into several $1,000s saved every year. For retirees living on fixed incomes, this can make the difference between financial comfort and unnecessary stress. Eligibility is the first hurdle. Not all retirees automatically qualify, and the rules can seem complex at first glance. Typically, eligibility depends on factors like age, filing status, income level, and sources of retirement income. For instance, retirees who receive pensions, certain investment income, or Social Security may qualify differently based on their total taxable income. The key is understanding these rules so that you can position your finances to take full advantage of the deduction. Ignorance here is costly. Even a small oversight can reduce the amount you're allowed to claim. Another important aspect is timing. Many retirees assume that deductions are only applied once per year or that they can't be coordinated with other tax strategies. In reality, proper planning throughout the year can maximize the benefit. For example, adjusting withdrawals from retirement accounts or timing the sale of investments strategically can increase your deduction eligibility. This proactive approach ensures that you aren't paying unnecessary taxes and that the 40,000 deduction works as efficiently as possible. The psychological benefit is often overlooked. Retirement is not just about numbers, it's about peace of mind. Knowing that a significant portion of your income is protected from taxation provides confidence and financial security. Retirees can focus on enjoying their lifestyle, spending time with family, or pursuing passions rather than constantly worrying about the IRS or running out of money. This peace of mind can transform retirement from a period of stress to one of true freedom. It's also worth noting that the deduction interacts with other tax strategies. For example, combining it with Social Security tax planning, charitable contributions, or strategic withdrawals from tax. Deferred accounts can amplify the savings. This is where many retirees miss opportunities. They focus on income in isolation rather than seeing how deductions, credits, and withdrawals work together to reduce overall tax liability. A well-informed approach turns a single deduction into a powerful financial lever. The takeaway is simple. The 40,000 deduction is one of the most impactful tools available to retirees, yet it is often underutilized. By understanding eligibility, timing, and coordination with other strategies, retirees can protect thousands of dollars from taxes each year. 8. Failing to leverage this deduction isn't just a missed opportunity. It's money left on the table that could have been used for travel, healthcare, investments, or simply enjoying the retirement lifestyle you've worked so hard to achieve. At the end of the day, knowledge is power. The 40,000 deduction is more than a number on a tax form. It's a strategic advantage that can boost retirement income, reduce financial stress, and protect the life you've planned. For retirees ready to take control of their finances, understanding and applying this deduction is a critical first step toward maximizing both security and freedom. Social Security tax cuts. Maximizing your benefits. For many retirees, Social Security is the cornerstone of retirement income. It's the reliable paycheck that covers essentials, provides peace of mind, and helps sustain lifestyle choices. Yet, despite its importance, a surprising number of retirees pay more taxes on Social Security than they need to, and many are unaware that recent tax changes could save them thousands of dollars each year. Understanding these Social Security tax cuts and knowing how to maximize them is a critical step toward protecting retirement income. First, let's understand the basics. Traditionally, Social Security benefits were partially taxable based on your total income, depending on your filing status and combined income, including pensions, investments, and other retirement account withdrawals. Up to 85% of Social Security could be taxed. This meant that even modest retirees could lose a significant portion of their benefits to federal taxes. For those living on fixed incomes, this tax bite could directly impact lifestyle, healthcare choices, and long-term financial planning. Recent changes have created opportunities to reduce this tax burden. By understanding how income thresholds and deductions work, retirees can strategically structure withdrawals to minimize the portion of Social Security subject to taxation. For example, delaying withdrawals from certain retirement accounts or coordinating distributions with other deductions can lower taxable income. This is not just a minor tweak, it can mean retaining thousands of dollars each year that would otherwise be lost to taxes. Maximizing these benefits requires a combination of awareness and planning. Many retirees make the mistake of treating Social Security as an automatic income stream without considering how it interacts with other retirement income. Timing is crucial. By carefully planning when to claim Social Security and how much to withdraw from taxable accounts, retirees can stay below key income thresholds, thereby reducing or eliminating Social Security taxes. This is strategic financial planning at its most practical. Another often overlooked aspect is the interaction with deductions like the 40,000 deduction we discussed earlier. These deductions can directly lower your combined income, which in turn reduces the taxable portion of Social Security benefits. When applied together, deductions and tax cuts can create a compounding effect, maximizing take-home income without changing lifestyle or reducing benefits. This is why integrated tax planning is essential for retirees who want to truly optimize their Social Security. The psychological impact of these tax cuts is significant. Many retirees live in constant worry about stretching their benefits, especially as healthcare costs, inflation, and unexpected expenses arise. By strategically leveraging Social Security tax cuts, retirees gain not just financial relief, but confidence and peace of mind. They can focus on enjoying retirement, traveling, pursuing hobbies, spending time with family, rather than constantly calculating how much the IRS will take from their benefits. Finally, maximizing Social Security isn't just about saving money in the short term, it's about long-term financial security. Retirees who plan properly can preserve more of their benefits, allowing savings to last longer, investments to grow, and lifestyle choices to remain flexible. This strategic approach ensures that Social Security continues to serve as the reliable foundation it was intended to be, rather than a taxed, diminished portion of income that limits freedom. The takeaway is clear: Social Security tax cuts are not just numbers on a form, they are real money in your pocket. And the difference can be life-changing for retirees. By understanding income thresholds, coordinating withdrawals, and combining these cuts with other deductions, retirees can maximize benefits, reduce taxes, and create a financial environment that supports both security and freedom. At the end of the day, knowledge, and strategy transform Social Security from a fixed benefit into a powerful tool for retirement planning. Leveraging these tax cuts allows retirees to protect their income, enjoy their lifestyle, and gain confidence in their financial future, all without sacrificing the benefits they've worked so hard to earn, the hidden savings most retirees miss. When retirees think about saving money in retirement, they often focus on cutting obvious expenses like dining out, travel, or unnecessary subscriptions. But the truth is, the biggest opportunities to save thousands of dollars often lie in areas many retirees overlook, like taxes, deductions, and benefits planning. JP Morgan's research and tax studies reveal that a surprising number of retirees leave money on the table every year simply because they are unaware of the hidden savings available to them. Understanding and acting on these opportunities can dramatically increase your disposable income and enhance your retirement lifestyle. One of the most common areas where retirees miss out is deductions and credits related to income taxes. Many retirees fail to claim deductions they qualify for, whether it's the 40% deduction, medical expense deductions, or other age-related tax breaks. Each missed deduction is literally money lost, money that could have been used to pay for healthcare, travel, or long-awaited experiences. Even small mistakes, like failing to adjust withholding or not coordinating withdrawals from retirement accounts, can result in thousands of dollars lost annually. Social Security is another area ripe with missed opportunities. As we discussed earlier, strategic planning around Social Security can significantly reduce taxes. Yet many retirees either start benefits too early, withdraw from taxable accounts without consideration of thresholds, or fail to coordinate deductions with Social Security income. The result is overpayment in taxes, often unknowingly. 8. By understanding income limits and timing withdrawals wisely, retirees can take full advantage of the tax cuts and deductions available to them, capturing savings that can add up to tens of thousands over time. Healthcare-related savings are frequently overlooked as well. Medical expenses, prescription drug costs, and insurance premiums are often deductible, but only if retirees track and claim them correctly. Many fail to keep records or consult with tax professionals, missing out on deductions that could dramatically lower taxable income. For retirees on fixed incomes, these hidden savings are not trivial. They can directly impact quality of life, allowing for better healthcare access, healthier diets, or simply more financial breathing room. Another critical area where retirees miss out is strategic retirement account withdrawals. Without careful planning, withdrawals from IRAs, 401ers, or other tax-deferred accounts can push retirees into higher tax brackets, increasing both regular income tax and Social Security taxation. Many retirees follow a set schedule or withdraw amounts without considering the tax implications, leaving substantial potential savings unclaimed. By planning withdrawals strategically, coordinating amounts, timing, and account types, retirees can reduce tax liability and maximize after-tax income. The emotional and psychological cost of missing these savings is significant. Retirees often feel stressed, anxious, or limited in lifestyle choices, believing they need to tighten budgets or farrago experiences. In reality, a significant portion of this stress is unnecessary. It stems from unclaimed deductions and missed planning opportunities. By identifying and acting on these hidden savings, retirees gain financial breathing room, reduce worry, and reclaim control over their retirement. Finally, missed savings aren't just about money, they're about empowerment. Retirees who understand tax laws, deductions, and strategic planning can make informed decisions rather than leaving money on the table by default. Every deduction claimed, every withdrawal timed correctly, and every tax credit applied is a step toward greater financial security and a richer retirement experience. The takeaway is clear. Hidden savings exist in abundance for retirees, but only those who are informed and proactive can claim them. Ignoring these opportunities means losing money unnecessarily, while careful planning can unlock thousands of dollars each year, improving quality of life. and reducing stress. At the end of the day, retirement isn't just about income, it's about making your money work smarter, not harder. By uncovering and acting on hidden savings, retirees can enjoy more freedom, more experiences, and more peace of mind while preserving the financial security they've spent a lifetime building. Planning ahead, combining deductions, tax cuts, and smart withdrawals, retirement is not just about surviving, it's about thriving. And thriving financially in retirement requires more than just earning or saving money. It requires strategic planning. This is where the real power of tax deductions, social security tax cuts, and retirement account withdrawals comes into play. While each element is valuable on its own, the true impact emerges when retirees plan ahead and combine these strategies to maximize savings, protect income, and secure long-term financial freedom. At the heart of this approach is understanding how deductions interact with other sources of income. For example, a 40,000 deduction can significantly lower taxable income, but when paired with careful timing of retirement account withdrawals, the savings multiply. By strategically withdrawing from IRAs, 401ks, or other tax-deferred accounts, retirees can avoid pushing themselves into higher tax brackets, reducing both income tax and the taxable portion of Social Security benefits. Planning ahead allows retirees to orchestrate their income in a way that minimizes taxes while maximizing disposable cash flow. Social Security tax cuts are another crucial piece of the puzzle. Many retirees claim benefits without considering timing or tax implications, resulting in unnecessary taxation. By coordinating deductions, withdrawals, and Social Security claiming strategies, retirees can reduce the portion of benefits subject to tax. For instance, delaying Social Security until reaching full retirement age or using tax-efficient withdrawal strategies from other accounts can help maintain income while keeping taxes low. The combination of these strategies can save thousands of dollars annually, money that can be reinvested, spent on lifestyle, or added to emergency reserves. Healthcare costs, often one of the largest retirement expenses, also intersect with strategic planning. Medical expense deductions and health savings account (HSA) contributions can be coordinated with withdrawals and deductions to further reduce taxable income. By thinking holistically, retirees ensure that every dollar earned or withdrawn works efficiently, both to cover costs and to reduce tax liability. This is where planning ahead separates financially empowered retirees from those who leave money on the table. Timing and consistency are critical. Strategic planning isn't a one-time event, it's a continuous process. Retirement spans decades, and income needs, market conditions, and tax laws change over time. By regularly reviewing income sources, deductions, and withdrawal strategies, retirees can adjust their plan to maximize benefits and protect their financial position. Flexibility and foresight turn small annual savings into substantial long-term gains, creating a compounding effect that can significantly boost retirement security. The psychological and lifestyle benefits of this planning are profound. Financial uncertainty is one of the biggest stresses in retirement, yet strategic planning reduces that stress by providing clarity and control. Retirees who combine deductions, tax cuts, and smart withdrawals are not just saving money, they are gaining confidence, freedom, and peace of mind. This empowers them to focus on the lifestyle they want, whether that's travel, hobbies, or supporting family, without constant worry about finances. Finally, planning ahead creates optionality. A coordinated approach allows retirees to make decisions from a position of strength rather than necessity. They can adapt to unexpected expenses, changes in the market, or healthcare needs without compromising their lifestyle. The combined effect of deductions, Social Security tax cuts, and strategic withdrawals ensures that retirees maintain control over both their money and their choices, truly living life on their own terms. The takeaway is simple but powerful. Individual deductions or tax cuts are beneficial, but the real magic happens when they are strategically combined and planned over time. This proactive approach protects income, reduces taxes, and maximizes disposable funds, creating a retirement that is not just financially secure, but genuinely enjoyable. At the end of the day, retirement success is about more than savings, it's about strategy. By planning ahead and integrating every available tool, deductions, social security tax cuts, and smart withdrawals, retirees can preserve wealth, reduce stress, and fully enjoy the freedom they've earned. This coordinated approach transforms retirement from a period of uncertainty into a period of financial empowerment and peace of mind.